And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Chuck Self, and he serves as the CIO, the Chief Investment Officer, and COO, Chief Operating Officer at iSectors LLC, with approximately $400 million in AUM. Chuck, thank you very much for coming on the show today.
Well, thank you for having me, Adam.
So, Chuck, I always like to begin. Can you tell us your story and how you got involved in this business?
Well, like everyone else, I wasn't one of these people who, as a teenager, knew that I was going to be in investment management. Very few people are that way. But I grew up in the 60s and 70s, and of course, this was pre-internet. So you got all your information from broadcast and news and the newspaper. And so I loved the newspaper. And then there were these pages that had numbers all over those pages, and so given that I was a number-oriented person, I learned that those were stock market quotes. I got interested in understanding what was going on in the stock market. Fast forward a little bit, I ended up getting an MBA in statistics and finance from the University of Chicago, but the only way I could have gotten that is that someone had to pay for it. I couldn't see how I could, in 1979, pay the outrageous price of $5,300 for an MBA education. So I was fortunate that the Northern Trust paid for the MBA, and as part of the process, I got an internship with them. They put me in the investment management area, and that started my investment management career. I became a bond geek, I think because of my statistics background, and I was that for 20 years. And then I had the fortune to become the Chief Investment Officer of the Illinois Teachers Retirement System. And so in that process, I learned about other asset classes and asset allocation. So for the last 6 years, I've been doing asset allocation work for advisors at iSectors in Appleton, Wisconsin.
Oh, wow. I love that story. So as a teenager, you got fascinated with the market just by seeing the numbers change daily when you would read the paper?
Yeah, right. Yeah.
Wow.
I just, again, because I was always good in math and I was numbers oriented, I just wanted to try to understand what all these numbers were about. And so kind of on my own, I learned about finance and the importance of equity financing for companies just by following the stock prices and started doing small amounts investing with my part-time work money and not really expecting that I would actually be in this business, but it turned out well.
Excellent. No, I love that. And then you got involved. You said you were in with the Teachers Fund. So how is it working in an institutional setting like that versus on your way up or afterwards, where it's more of a different role? Do you see things differently?
I was fortunate in that in most of my bond career, I was working with institutional investors, so I knew what it was like. And the good part about working with institutions like the Illinois teachers, is that I got the opportunity to be exposed to all different asset classes. At the time I was there, it was a $30 to $35 billion fund. So beyond fixed income and beyond equity, we had a large real estate portfolio, a large private equity portfolio. So I was able to get exposed to the full range of asset classes, and it really set me up for the work I do now with advisors, because I understand the pros and cons of different asset classes. And I was at Illinois Teachers just at the beginning of the ETF revolution, so you didn't really have many ETF choices at this point. At least advisors didn't have many ETF choices at that point. But once the large amount of ETFs became available and the many different kinds, I was able to understand why you might want to have precious metals ETF or a merger arb ETF, because I did all that work when I was at Illinois Teachers.
I love that. So now you're at iSectors. Can you tell us a little about what you do in your investment strategy?
Yeah. So at iSectors, our major goal is to keep advisors, clients invested. as long as you stay invested, over the long run, stocks go up, and as long as you stay invested, you will be perfectly fine. The problem is that not most people can't live with the volatility of the stock market and at all times, and so our goal in the work that we do is to minimize downside risk in clients' portfolios. And we've been doing this for 15 years now. So we've been through a couple of bear markets, and we've been, just by focusing on minimizing downside risk, we've been able to have results that are better than the standard indices. But even more important than that, for our advisors, they don't get calls from their clients say, sell me out when the market has the declines like we had earlier this year, because we have minimized those downside risks. The problem with when clients call advisors and say, sell me out, is of course they're going to get back in the market probably at significantly higher levels, and often the clients blame the advisor for what happened, even if the clients called. So it's important to us to keep the clients invested, and if they do that, they'll be able to meet their goals.
So I love that. How do you, if you can elaborate, please, a little, how do you minimize the downside risk?
Yeah. So in our primary strategy, it is a sector allocation strategy in the market. So it happens in a couple of different ways. One, we use sectors that are diversified from each other. We don't use all of the sectors in the U.S. market, but we use sectors that are diversified from each other, and we give ourselves the ability to own long-term treasury bonds and gold mining stocks as part of the process. Two, we use a quantitative process. We're quants in that regard, and we have a proprietary quantitative process that is very sophisticated, and it again focuses on what portfolio do we expect is going to minimize downside risk, given what variance you're willing to take on that, and then finally we use exchange traded funds and index ones so that we're able to get the lowest cost portfolios to clients. And the combination of those 3-4 things are what we do in order to have advisors, clients, be able to experience minimized downside risk.
That makes perfect sense. So it's just diversifying the portfolio and then using that quantitative overlay to make sure that you can zig when the market zags, or do your best to zig when the market zags, so to speak.
Yeah. And again, what we emphasize is that no one can predict the market.
Right.
And this is not a market timing model. All it is, and I have a degree in statistics, and so I understand these things, and I try to have our advisors understand these things. Is that all we're trying to do is say, is this a time when there's big downside risk? If there is, we'll get more conservative, and if it's a time where there's relatively little downside risk, then we'll be aggressive. And again, and we're always invested. We're never in cash. My view is that cash is trash because it's so difficult once you go to cash to figure out when you should go back in, and then in the meantime you're earning a return that's less than inflation. So we're always invested in one of those sectors, and more of those sectors, and again, it's worked out well historically.
Excellent. So, Chuck, I guess next question is, how do you handle risk, and what mistakes do you see people make with respect to risk management?
Yeah, we think the industry is lazy when it comes to risk management for the most part, because the industry really has historically, especially the quantitative part of the industry, has focused on mean variance optimization. And because of that, they're focused on standard deviation as the measure of risk. Harry Markowitz from my alma mater, University of Chicago, wrote a seminal paper in the early 1950s about modern portfolio theory. at that time, he had little computer power. In fact, you have more computer power in your phone that he had available to him at the University of Chicago at that time. So when he wrote the paper, he chose mean variance optimization to prove his points on modern portfolio theory, just because he could do that work by hand, and slide rule, I assume, in order to get it done. Amazingly, it is still used widely today, mean variance optimization, even though we have much more computer power and much more sophisticated quantitative process available. Harry Markowitz is still living in California, and if he was on the phone with us today, he would tell you that mean variance optimization is a terrible way to create portfolios. And again, and the focus on standard deviation is a terrible way to measure risk. He has himself said that downside risk is his measurement of choice. And so we spent 3 years creating a process that was focused on downside risk in order to serve our clients.
If you don't mind, Chuck, can you just clarify or define to the audience those two terms?
The two terms being
mean various up downside. Well,
mean variance optimization and downside risk.
Yeah, and what the fallacies are, or how the Main Street or most of Wall Street, is just misunderstanding it. So, like, what is it, and then how they misunderstanding it.
So, of course, so mean variance optimization is a process where what you try to do is for every level of risk, which is defined by standard deviation, you come up with the highest level of return. Or the other way of talking about it is for every level of expected return, you try to minimize risk. And if you can, again, because of the computer power we have today, it's easy. If you have a series of expected returns in the future, it's easy to create those points. And of course, those points is the the optimal line of at any point at risk, figuring out what the mean is. And so that's what a lot of people do. But there's a lot of problems with that. One, you got to have a prediction on what the returns are going to be for any asset class going forward. And asset classes over time have a pretty knowable distribution of returns, but you never know the pattern of when those returns are going to occur. The second thing you got to know is the standard deviation or the risk between those returns, and that is the absolute easiest thing to predict. It turns out, in that standard deviations tend to be consistent over time, and so that's why the world focuses on it, because if you knew the standard deviation of a class of equities over the past 30 years, it's likely that that's going to be the standard deviation for the next 30 years. But the absolute hardest part of the equation is knowing the correlation between the different asset classes. How much will the different asset classes or the different assets that you use in your portfolio will move together over time? That is very unstable. And you can look at historical correlations, and it could tell you nothing about what's going to happen going forward. And so we have times in which, let's just take in recent times. Usually, gold prices have zero correlation with the equity market, meaning that it's completely independent of it. But it has actually had significantly positive correlations over the past 3 months. As stocks have gone up, gold has gone up. As stocks have gone down, gold has gone down. And so it's very difficult to estimate those variables, mean variance, which is measured by standard deviation and correlation, in order to have a model that's going to work. And that's why most mean variance optimization models are not that good.
Yeah, actually, back in February, on February 17th, I had a gentleman named John Gerard who used to work with Markowitz, and they had a fund together on,
Ah,
and he actually echoed your exact points. So it's really fascinating to me to hear two different people that are unrelated have the exact same comments about inherent flaws in the way things in the way things work, so to speak. So just to translate what
yeah,
you just, yeah.
And Harry has been very public about this
Oh
over
yeah.
the decades, and so this is it's again, it's not that we have some secret sauce that no one else has as far as how the model should be structured. It's just that it takes time and it's difficult, and most people don't want to take the time and money and difficulty to do that. And I'm fortunate that our CEO and founder, Vernon Sumnick, was willing to spend the 3 years to do that.
No, it makes perfect sense. So just to translate what you just said to the audience and make sure I understand what you just said, the mean variance optimization is like, listen, there's risk and there's reward for any asset class, but no one knows what it is. There's the unknown. So they use standard
Right.
deviation to say, hey, listen, in the last X amount of years, 30 years, 10 years, whatever the case may be, if asset class A moves 10 points in a given day, then that standard deviation be 1, whatever, or in that case 10, or whatever the case may be. So if it goes 50 points in that day, it's a 5 standard deviation move higher, or whatever the case may be, 2 standard deviation move higher, and that throws things off. Or it's a way to use a standard deviation based on historical volatility to measure the projected reward, so to speak, or performance of the underlying asset. Is that correct?
Yeah, yeah. And like I said, for standard deviation, that's not a bad thing. The hardest part is the correlations
Right.
between different asset classes. And in our process, we don't have to estimate any of those things because we use historical factors in order to say, well, historically, when this set of economic situation that we have today presents itself, how does the market work? So we don't have to sit there and either use historical or predictive investment returns and correlations, especially in order to create our model.
Yeah, that makes perfect sense. So just to make sure I understand, high level advisors or the audience or listeners to the show, individuals that come to you and say, listen, I want these kind of portfolios set up, and they'll be able to access all of that through you.
Yeah. We have all of our models on both brokerage and third party platforms, and we have a wide variety that we're on. We are ourselves just an intellectual property firm. We don't actually have retail clients as our clients. We work only with advisors, and our work is only available through advisors. So that's one of the great things, that advisors that utilize our work, they're creating portfolios that can't be created by the clients themselves because they don't have access to our work.
Yeah, that makes perfect sense, and that's a good added value prop for the advisor.
Right.
Yeah.
Right. Yeah. And then if they stay with us long enough and it works, then the advisor has a leg on other advisors, and then there's word of mouth, and we've been very happy with the word of mouth that has taken place with the volatility this year. It's kind of a sad situation in that we usually have our best years when the market is having its worst years, because that's when downside protection is most important. And so we've had a couple of great years starting from the fourth quarter of 2018 when we had that almost 20% decline
right
that quarter.
Yeah. So there's that old adage on Wall Street that says everyone's a genius in a bull market, right?
Yeah, that's right.
That's it.
Yeah, and that's it. If in a bull market, in a bull market, because we have this kind of added insurance aspect, we tend to be where the market is as far as returns are concerned. Where we really shine is in bear markets, and fortunately, it has continued with the one this year.
Excellent. So that makes perfect sense. So I guess, Chuck, my next question for you, what are some timeless lessons you've learned along the way that you'd like to share with the audience?
Yeah, the most important lesson is to be disciplined. My belief is that there's many ways to outperform the market. It's hard. I'm not going to say that it's easy to do so, but almost any disciplined process will get you to where you need to be. The problem in our industry is that there are too many factors for the human mind to be able to put together and say, this is the way the market is going to go, whether it's up or down. And the correlations between the factors and then of course correlations between asset classes are so difficult that trying to invest by the seat of the pants is going to be unprofitable. And so and then of course you're going to be right every now and then, even if you invest in by the seat of pants. It's kind of like the stop clock
right
thing, that you're going to be right a few times, and then people think when they get right, then they think I'm a genius, and so they think they know how the markets work. Well, the markets are so difficult that that's why we rely on disciplined quantitative processes to and again, even with our quantitative process, we're not able to put in inputs of all the factors that are moving in the markets, but all we have to do is outperform all the other people that are investing by the seat of their pants.
Right.
And if we do that, then advisors will want to put their clients in our strategies. And so I don't say that our disciplined process, our quantitative process, is the one and only way to make money or invest clients' money. It works for us, but if you're an advisor or you're a client, you just want to make sure that your investment managers are using processes that are not dependent on whether someone can wake up in the morning and decide where the market is going to go. It's got to be something that's repeatable and that with some training, almost anyone could do.
Yeah, that makes perfect sense. And then the other side of that, what are some timeless mistakes you see people make, and how do you recommend people avoid them?
Well, I guess this is kind of correlated in that, again, people are always searching for human gurus to listen to.
Right.
And I've been in the investment market for almost 40 years professionally, and there's not been a single guru who has lasted throughout the whole 40-year time period, because there's going to be times in which they're right, which is they're wrong. And most gurus get their status by calling for declines in markets, and then later on people say, well, that guru called the decline in the markets in 2007 to 2008. And when you look back at their record, what you'll find is they were calling for declines in markets all the time.
Since 1950. Yeah, exactly. Since 1950. Yeah. Right.
Yeah, and then, I'm not going to name names, but there's a guru right now that had predicted that long-term treasury bonds were going to go to under 1%, and now everyone is really excited in the bond market about this guy. Well, this guy has been bearish on interest rates for years and years and years, and finally he's right. And so I really caution the audience to not put their stock in a single person or a group of people. No humans are going to have all the answers, and again, you got to do the hard work. This is a very difficult profession, and very few advisors have the time or ability, or should take the time to do investment management. They really should outsource it to people who are doing it as a full-time position, and spend their time with their clients, getting new clients, running their firms, and so on. So that's the way we think that financial advisors should handle the investment process.
Yeah, no, it makes perfect sense because they make more money that way, right? It also helps them.
Right. Yeah. And in fact, there's studies out there of elite advisors, those that have over $1 billion versus those that don't have $1 billion, and how they use their time. And those elite advisors have a relatively small amount of time on investments. And part of the problem, if you're going to do it yourself, is that you got to also spend the time trading. You got to settle the trades,
right,
do all the operations, and so on. And every minute you're doing that is a minute away from your client, or a minute doing
prospecting
a
or whatever
presentation to get your firm to grow. So it's important that if you really want to be an elite advisor, if you're not doing this as a lifestyle thing, that you focus on serving your clients and getting new clients in the profession. And there's hundreds of firms like ours to choose from, but to outsource it to firms like ours.
Yeah, that makes perfect sense. What's the best piece of advice you can share with the audience, on or off Wall Street?
Yeah, well, I'll do on Wall Street because I'm not certain I have great advice for off Wall Street, but at least on Wall Street, it's a simple thing, and that is, and again, Harry Markowitz said it, is that diversification is the only free lunch. The problem that most people have is that their portfolios are under diversified.
Right.
And if they might have, if they might have stocks, they might have bonds. In fact, this is really interesting. We had a 401k plan that was presented to us, and they asked, if we want to help run it, and they gave us the choices that the participants had. And 7 of the 9 choices we had were U.S. Equity market choices,
right?
That have high correlations to each other.
Right.
So if someone put 1/9 of their portfolio on each one of those things, they would say, "Oh, I'm really diversified. I have 9 choices." But the reality is you had a very large U.S. equity market allocation, and so you always got to understand again how much do your investments move with each other, how correlated are they, so that you can have true diversification in your investments. And then the reality is that you need not, you have to go beyond just equities and bonds, and you should be looking at liquid alternatives, again, such as commodity funds, precious metal funds, real estate funds, things that don't move with equities or fixed income, in order to get the diversification that you need. And the whole point is not to try to pick investments that all are going to go up. In essence, just pick the best investments. The whole point is to pick a variety of best investments, because you have no idea whether the market's going to go up or down in this week, next week, or in the coming years. And so you want to be able to have some investments that'll do really well, and then the other ones, are just okay. And if you do that, then you'll win the investment game.
I love it. So to build a diversified portfolio, what would you say are a few ways to do that, for either quantitatively or non-quantitatively? It's pick a variety of best investments, watch for correlations, stay invested. Are those the 3 big ones, or are there other things that you can add to that?
Yeah, and obviously your returns over time is going to depend on how much you put in equities versus the other investments.
Mm-hmm.
And what it really comes down to is how much risk can you take. It's great that it's not great, but one of the good things that have come out of the bear market that we've had is that everyone has had to figure out whether their portfolio, the risk in your portfolio is risk that you can live with. And if you didn't have any problems going to sleep at night throughout the market decline in February and March, then you probably have a good risk a good amount of risk in the portfolio and the right amount of risk in the portfolio. And in fact, you can even decide if you want to take on more risk, but certainly that's not something you have to worry about. If you're checking the prices of securities or your funds or whatever regularly on one of the financial news sites, and you're losing sleep over it and worried about it, then you probably have too much risk in your portfolio. And so the standard historically has been a 60-40 portfolio. You have 60% in stocks, 40% in bonds. Over time, that has been a very good portfolio as far as beating inflation and reaching the goals that most people need to reach for retirement or college education or whatever. And now all we're saying is that you need to be even further diversified, especially with interest rates as low as they are. And maybe you take 10% from the fixed income side and put it in one of these liquid alternative investments. We think precious metals is a great one at this time, and so and then live with that portfolio for a while. See if that portfolio, if the risk in that portfolio over a few years is something you can live with, and if so, then you got a good portfolio. If not, then you just change it over time. And so I think all financial advisors will tell you that trying to figure out the risk of their clients is a kind of a give and take thing. You try things, see what happens, and then if they can't live with it, then you try something else. And I think that's what most individuals should do also.
I love it. Well, Chuck, thank you so much for coming on the show. You've really gave us some good takeaways here, and it's been an absolute pleasure.
Well, Adam, thank you so much for having me.
Pleasure.